wow, what a difference a week makes, right? Just when we thought November was shaping up to be a total downer, Wall Street got this massive dose of holiday cheer. The markets just took off, and honestly, it felt like it came out of nowhere. So the big question is, what just happened? Let's dig into this unexpected feast for investors and figure it out. I mean, you remember, just a couple of weeks ago, the outlook was pretty bleak. The mood was not great. Everyone was getting worried about AI's slow returns, and you could feel this growing stress in the credit markets. It really felt like we were all just bracing for a pretty rough end to the year. But then, bam, the entire script just got flipped on its head. Over that short Thanksgiving week, the market absolutely exploded. We're talking the S&P 500 jumping 3.7%, the Dow up 3.2%, and the Nasdaq, get this, soaring nearly 5%. Just a stunning turnaround that left everybody asking the exact same question. Why? What on earth just caused this? Okay, so it turns out the answer really comes down to two main characters in this whole drama. You've got the Federal Reserve on one side, and on the other, maybe the more surprising hero of the story, the American shopper. Let's break down what each of them did. So let's start with the shopper, and just look at this number. It's staggering. According to Adobe Analytics, online sales on Thanksgiving Day alone hit $6.4 billion. That one data point was like a thunderclap for the market. It basically shouted that, hey, despite all the inflation worries, people are still spending, and it just shattered those fears of a consumer slowdown. And believe me, this was not just a one-day wonder. Nope. Projections for Black Friday showed a spending jump of over 8% from last year. And we saw this same optimism in really strong earnings reports from retailers like Dick's Sporting Goods and Abercrombie & Fitch. It all just confirmed what Walmart had been hinting at the week before, that the American consumer is way more resilient than anyone was giving them credit for. All right, now for our second big driver, the Fed. And to get what happened here, we need to quickly talk about two words you hear all the time, dovish and hawkish. It's pretty simple, really. Think of a hawk as aggressive, right? So a hawkish Fed wants higher interest rates to fight inflation. And a dove? Well, a dovish Fed is gentler, favoring lower rates to help the economy grow. And last week, let's just say the market heard a whole lot of cooing. So what actually happened? Well, a few different Fed officials got up and started talking, and their whole tone just shifted. Instead of hammering on and on about inflation, they started talking more about the other half of their job, employment. Now, for traders, this was a huge signal. It was like a giant flashing sign that said, hey, we're probably done hiking rates, and maybe, just maybe, cuts are on the horizon. But, it's never that simple, is it? This is where the story gets a little more complicated. Because while the overall market was way up, this big wave of good feeling, well, it didn't lift all boats equally. It was definitely a tale of two very different markets. So on one side, you had your clear winners. Tech and AI stocks just roared back to life. And of course, retail and consumer stocks were flying high on all that shopping news. But then you look at the other side. And sectors like industrials and healthcare, they were fighting some pretty serious headwinds. That tech comeback was something else. I mean, you had software companies like Zoom and Intuit just crushing their earnings, proving that maybe these big AI bets are finally starting to work. Then you have the hardware guys, Dell and HP, talking about a huge backlog for their AI gear. And then, as if that wasn't enough, you get geopolitical news about possibly looser chip export rules to China. I mean, that just poured gasoline on the fire. Meanwhile, it was a totally different world for other companies. You had Deere coming out and warning that tariffs could hit them for over $1 billion. Ouch! And the health insurance stocks were all over the place because of uncertainty around government subsidies. It's just such a stark contrast, and it really shows you that split in the market's recovery. So, all of this brings us to the million-dollar question, right? Is this the real deal? Are we looking at the start of a classic December melt-up, or was this whole thing just a temporary sugar high? Well, the week ahead is absolutely loaded with economic data that's going to put all this new optimism to the test. And I mean packed. On Monday, we get a read on manufacturing, and we hear from Fed Chair Powell himself. Midweek is all about the job market. We've got payrolls and claims data. But the real main event, the one everyone is waiting for, is on Friday. That's the core PCE inflation report. Why does it matter so much? Because it's the Fed's favorite way to measure inflation. So yeah, that report could literally make or break this whole rally. Every single one of these numbers is going to be under a microscope.
Okay, but here's where the plot really thickens. Because despite all the great headlines and the big jumps in the indexes, if you peek under the hood and see what traders are actually doing with their money, you find a whole lot of caution. It's a little weird.
Let's look at the Fear and Greed Index, for example. Sure, it's up a little from where it was, but it's sitting at 24. Anything under 25 means fear. So just let that sink in for a second. The market is soaring, but this key indicator is telling us traders are still scared. That is a major disconnect.
And then there's this, the put-call ratio. Now this is just a fancy way of measuring bearish bets against bullish ones. A put is a bet that stocks will fall. A call is a bet they'll rise. A number over 1 means there are more bearish bets than bullish ones. And right now, the reading is 1.48. That's not just a little bearish, that's heavily bearish. It means a lot of traders are actively buying insurance against a market drop.
And if you dig even deeper into the components of that fear index, it gets even more telling. Things like market breadth, which basically asks how many stocks are actually going up with the market, are flashing extreme fear. Same thing with the demand for risky stuff like junk bonds. What this tells us is a really crucial story. A handful of huge tech stocks might be dragging the whole market up, but the average stock isn't really participating, and traders see that. So that's the strange paradox we're left with. We have a market hitting new highs, seemingly powered by great news about the economy. But underneath it all, we have traders who are still betting it's all gonna fall apart. So, which is it? Are we looking at the beginning of a massive year-end melt-up? Or is this just another false rally, a fragile one built on a foundation of fear? The numbers we get in the coming weeks won't just tell the story, they are probably gonna decide the market's fate for the rest of the year.